Hello everyone, my name's Chris Springett, a tax partner at Smith & Williamson, and welcome to our podcast S&W The Pulse. Delighted to be joined today by Will Tremlett from Sotheby's International Realty. Afternoon, Will.
Good afternoon.
Today's topic, we're talking around really the property climate, what's going on in the market at the minute, particularly driven by a lot of the tax changes that we've seen. Will, anything worth speaking about initially on how the property market is looking at the moment?
Well, the property market at the moment has seen great changes over the last 3 years. I think a lot of that is to do with the taxes. Being an estate agent, it's been very much the highlight taxes. It's not the hidden taxes, I suppose, which you are the expert on. It's more the stamp duty changes that have risen extraordinarily in the last 25 years. We've got the buy-to-let taxes, whether that will actually make individuals less attracted to buy-to-let and maybe leave it down to the professionals, how it was always perhaps started, to basically foreign buyers coming in knowing what they're going to take when they leave, if they leave at all. So it is a fascinating sort of part of our golden postcode areas. So really, I'm here as much to learn as much about the taxes as well, but I can comment slightly how the market has been affected.
That's very good, Will. Thank you very much for that. And you're right, there's been a raft of changes over the past, just in the past 6 years. Property very much seen as a giving tree by the government, really wanting to widen the tax base, share in the revenues from the increase in the property prices, but also influence behaviour, as you've alluded to, with the buy-to-let market particularly. You've mentioned some of the key ones, but I suppose to really canter through some of the many changes, back in 2013 was when it really started. So this was the introduction of ATED, the annual tax on envelope dwellings. So this idea that people were seeking to avoid the stamp duty land tax by buying properties in companies rather than directly owning them. Quite an area where I suppose non-resident buyers were active. That was the way they traditionally bought properties, or was perceived to be the way they traditionally bought properties. Have you seen many changes brought about from that by the way people are now focusing on their acquisitions?
Very much so. I think, yes, prior to that, it got quite extensive in a lot of sales that their first question was almost, is this in a company name or can I buy it in a company name? I think George Osborne at that stage, there was a whole raft of media speculation on that, and he really tried to draw that back in. What it did do was advice from solicitors, and it effectively said that if you are buying a property, just buy it in your own name. And therefore, yes, you'll be taxed and all this and all that, but it might be more overlaid by other taxes. So therefore, they were very much pushed out of the company purchase.
Yeah, and I think that reflects what we're seeing as well, Will, on our private clients, our international private clients, where in the past that was the method, but now it's very much direct ownership. The interesting area, I suppose, and one that we've been hoping for some reliefs, are people who are perhaps already bought in these kind of structures and are now looking to exit or de-envelope, as it's often referred, but no reliefs really on that. And so it can be an expensive method of extracting yourself from a tax perspective. We've been hopeful for changes, but nothing's come through as of yet.
Well, one of the other aspects of buying a company that already exists is sometimes it's on the currencies. So the currency can make a big play. Today we've seen the lowering of the pound again due to Brexit, etc. So the thing is that dollar buyers coming into the pounds, whether it's onshore or offshore, is an interesting play in that as well. It may not affect the seller too much, but it may affect the position of the buyer coming in, hopefully to their advantage at this stage, but that's just a currency play.
Very interesting. You mentioned overseas buyers, international buyers. One of the things we've seen is the extension of the tax base. So in the past, non-residents, i.e. those not living in the UK, suffered no capital gains tax when they sold a property. That changed for residential property in 2015 and for commercial property in 2019. I suppose early days as of yet for that, the effectively properties were rebased for these international sellers from those relevant dates. But any sort of ripples in the market so far about those changes?
No, I think that people tend to be quite circumspect, whether selling or whether buying. They do need to take advice. I do plenty of 2015 valuations, whether they're buying or selling at the moment, and they've got to rebase it. It's interesting, though, that since the stamp duty increased significantly, and the market has gone down by, let's say, up to 20%, rough figures there, is a lot of properties that were worth, let's say, £2 million in 2015, now maybe down to 1.7, 1.6.
Very interesting.
So in a way, the government bringing that in and rebasing in 2015 perhaps haven't done them quite so many favours as was first thought.
Very good.
And I don't know if the stamp duty it has gone up slightly, but I don't think it's probably covered that side of things, interestingly.
Very good. You mentioned stamp duty. I suppose two big changes worth mentioning. The first one back in December 2014, we replaced the slab system with a progressive system of stamp duty. Helpful for those at the lower end of the market, but approximately 1 million and above suffered more stamp duty through the new system. And then back in April 2015, we had the introduction of a 3% SDLT surcharge for second or further properties.
Yeah.
Again, I mean, you've mentioned already, but it feels like this has had the dramatic impact on the property market.
It has. It's slowed it right down. It is, I'm afraid, quite a subliminal tax on the seller, because if a buyer has a budget, they're going to stick to that budget. And they've got to take into account that 12 to 15%, certainly on the higher numbers. And therefore, they will make their bid on what they will actually effectively have to pay. Whereas it was before, they sort of slightly swallowed the 5 to 7%. There was a bit more hope value in the market then. And if you were buying something at, let's say, £1 million and you had to spend 50,000 on it, you would expect it to sort of gallop along in the next couple of years, cover those costs, then you could see some genuine profits thereafter. But now if you are buying a £10 million house, you are effectively, as a second homeowner, effectively paying about £1.5 million for that out of hard income. Now, that's not to say that the house might be worth only 8.5, but to them it might be.
Yeah.
To the seller, it's still worth £10 million. So someone's got to come down or someone's got to go up. If they do buy it at 8.5, they've effectively bought it for 10. But what happens 2 years down the line, you suddenly want to go and realise your asset, you've got to move on, whatever. Is your house then worth £10 million or is it still worth 8.5?
Yeah.
There lies the slight problem. It shouldn't be, I mean, I should be a bit more positive about things because actually transactions are taking place. Sellers are being a bit more realistic. Buyers are, I think the better buyers are sort of halving that stamp duty back down to the 7% mentally. So they're giving that little bit extra. And that is where the communication and the people factor comes into the buying and selling process. So it's not all that bad.
Very good. Very good. Nice positive end to that. Thank you.
Thank you.
And I suppose the other change that you mentioned impacting those in the buy-to-let field was this big change in April 2017 around the restriction on mortgage interest relief for landlords. January 2019 was the first tax payment that flowed from those changes. Some landlords, many still will be reeling from the impact of that. You mentioned an impact on the buy-to-let market. Is this something that you're seeing flowing through? Now, clearly that was a deliberate attempt. Has that behavioural taxation worked?
Yes, I think on the individuals who perhaps want to purchase a second flat or house as a buy-to-let, maybe in place of a pension, they've got to think about it a little bit further. Is this going to be a longer term play, which I guess most of those kind of things are. I remember back in the day, the mortgage relief stoppage on usual mortgages, that had a bit of an effect. I think whenever there's a tax change or a tax regime change, the market takes a little bit of time to react. If the stamp duty went up 1%, we would probably see about 6 months worth of people adjusting to that. So I do think the market will always adjust. But what that does give, in another matter, is the individuals wanting to purchase a home get a little bit more freedom.
Okay, it's interesting. I mean, from our perspective, we're still seeing people active as landlords. That's not ceasing. People are seeing property as a good investment vehicle and a good way of a yield. But they are thinking a bit more strategically about how they structure their investment portfolios, be that paying down some debt and keeping the debt a more manageable level, or using structures to invest in their buy-to-let portfolios. So if they traditionally, or if they are seeing this as a business for them going forward, companies are now becoming quite a useful tool to allow them to invest in a buy-to-let portfolio going forward.
Which I think is where you could call them professionals.
Exactly.
So if you do have 3 or 4 or 5, I would regard that as a pretty professional buy-to-let person. Put it in a company, that's great. If it's the individual, it might just have to be a longer term plan.
And I think that's exactly right. And I think that is flowing through to the thinking now of many landlords. So that's what's happened. Thinking now what might be coming in the future, I think there's definitely more to come. Quite a bit more around capital gains tax, particularly around this idea of when individuals will have to pay the capital gains tax on property. So from April 2020, all individuals will have to account for and make a payment on account towards capital gains tax within 30 days of completion. I don't think that'll particularly impact the property market as such, but from an administrative perspective, I suppose it'll cause sellers a few headaches.
Maybe 1 or 2. I don't think anything serious there. It might affect a bit of timing of when they wish to try and sell it. But you never know in a market. It might take, how long is a piece of string? It might take a little bit longer. Do they prepare themselves a little bit earlier? What I don't know, Chris, is whether the 30 days, yes, you pay it, but can you then bring it back a little bit the following tax year? I don't know, but that's where we always say take advice.
Yeah, and I think that's right. I think broadly, yes, it is a payment on account that you're making towards the final liability. So still needs to go through the self-assessment tax return and still flows through that. But broadly, yes, I mean, it should very much just be considered a payment on account. I suppose the key thing, and this is where we all need to work together as professionals in this environment, is making sure people are aware of this change and making sure that they know that they only have this 30-day window to make this payment.
Very much so, yeah.
And another one kind of fits into that slightly, which is some changes around the private residence relief. So the relief that exempts an individual's main or only home from capital gains tax. Consultation has been ongoing on this, whereby we're going to see some changes to the rules. Happy to say no removal of the relief, which I think was of great concern at one stage, but it is definitely going to stay. One of the changes is around this final period of ownership. So to keep things relatively straightforward, where you move out of a property but retain it for a short period of time, you're deemed to still qualify for the relief over that period. That period at one stage was 36 months. From 2014, it's reduced to 18 months. From 2020, it'll be down to 9 months. I wonder if that will influence people's behaviour around how much they list properties for and how keen they are to sell, so that they don't fall foul of some capital gains tax exposure.
Yes, totally. That has been a movable feast. Thankfully, first up, they haven't put capital gains tax on a private
exactly
home as yet. That may be one of the next points. But yes, people again, it's getting their ducks in a row. They've got to sort of foresee what's going to happen. It's very difficult to do, but if they are realistic, they will sort of hand on heart know that they can sell for X amount, therefore they can purchase something else and know that their house, certainly if it's a normal domestic house, in relatively quick time. If it's more to do with the bigger stuff, maybe they can play it a little bit. You never quite know when the international factors come into it. But if you think of, let's say, the Wandsworth market, it's flowing quite well, so there shouldn't be any great panics. One other little thing that is interesting, and it's probably still being tested slightly, is if you purchase a very unmodernised house, you may not have to pay the surcharge, even though it's a second home, and it may actually give you a little bit of extra time on selling your own, certainly if it's deemed not to be habitable. That's going to be a very small part of that market, but it is another little point that if you want to fix up your next house, your forever house, you might actually have a little bit of time to play with that.
And that's interesting as well, I think, for both the capital gains tax and a stamp duty land tax perspective. The rules around capital gains tax are being codified. It's always just been a concession, so you were a bit dependent on HMRC accepting it, but they're now putting that into legislation as part of those changes. So good news, I think, from the consultation and a good outcome there, giving much more certainty to individuals as to when the relief will apply.
Exactly, it's that certainty, isn't it?
It is, yeah, very much so.
Knowing what you're going into.
Very much so, very much so. I suppose looking at even a bit further out on the horizon, other changes, there's been discussions around further SDLT surcharges for non-resident purchasers. Now that feels like it's been put a bit on the back burner, which I think you're probably going to say is good news, but I'd be interested to hear if there's anything been around the market about major concerns from that perspective.
No major concerns. It's a very small part of the market. Yes, we do deal with a lot of international purchasers coming in. That's not by no means our only bit of the market, but it was deemed to be a 1% increase. Again, slightly subliminal tax on the seller. If someone came along saying, well, I've got to actually pay 16%, it's probably not going to change that too much. Certainly with the flow of the currencies at the moment, if it suddenly turned the other way, maybe.
Yeah.
But at the moment, there hasn't been too much talk about it. Fingers crossed, it might have slightly slipped out of earshot for the moment.
So on the horizon, lots of political uncertainty at the minute. We're able to draw out a few potentials from what various parties and what various politicians are saying. One interesting thing is Boris Johnson, as part of his campaigning, has talked around making some drastic changes, I would suggest, to the SDLT regime. So lifting the threshold up to 500,000 before you start paying SDLT, and then cutting the top rate to 7%. Any thoughts on that, Will?
Well, in a way, yes. We've been saying for ages that the Osborne-led increases in 2014 was just a step too far. It hadn't gone from 5 to 7% relatively before then. So that was quite a shock. So the market slowed down towards 2015, and then people actually really, all that pent-up demand sort of got released. And then it sort of really came an issue. So it's been the last 4 years, or 3 years, sorry, as the big case. So if Boris did bring it down to 7%, I think it will have an effect. The sellers may not see the market rising too much.
Right.
The market will adjust. I always say that. But I think the sellers, to think that they will get an extra 7% is going to be quite tricky to actually really calculate. But I think it goes back to that same thing. Where people are paying less tax, they sort of probably feel a bit more comfortable with it, and so therefore they're going to pay it. Yeah. And actually, you might see, going back to the £10 million house, for example, is if one sale goes through, let's say that's £1.5 million to the Exchequer, you going back to the 5%, with somewhere in between here, of course, is you have to sort of sell 3 houses, but you've got the confidence, the sentiment in the market to purchase 3 houses by separate people. Yeah. So the market will flow a lot better, and you can understand it a bit better. So that little tip from Boris, hypothetically, could lead to a bit more flow in the market.
So flow rather than an increase in prices?
Initially, I think, yes. When you get the flow, you get the competition, and therefore you can then decide, probably almost 2 years on, you can look back and say, yeah, well, that's where the graph suddenly started to grow, as opposed to stagnate.
Very
so
interesting.
It will come about. But obviously, it's the headline.
Yeah. No, very much so. Very much so. And then looking at the Labour Party, recently published or commissioned a report around land in general, published last month. One of the things they discussed was around the phasing out of SDLT, particularly for owner-occupied homes, but the introduction of a progressive property tax payable not only by owners payable by owners of property, not tenants. So really based on current values of property and the like. So quite dramatic changes. Again, any thoughts on how that might impact the market?
Yes. I think without taking out the big hits from the Labour manifesto, whatever thoughts they have, I think it will affect mortgage affordability. I think the banks will look at that and say, well, you'll be paying, let's say, an extra £20,000 a year, so that's quite a big chunk of money. I do think it would hit the market. I think it would be such a radical change from our system that's been going on for so many hundreds of years that actually it could be a new way of doing it, but I don't think it's going to solve anything in the short term. I think people will be afraid to sell. I think they will be afraid to invest. And, we've got to look at the whole country. There are a lot of people out there all over England and Wales and Scotland, Cornwall, not with the glamorous numbers involved. And suddenly, if they get hit with their council tax as well, it just sounds like it's a bit of an idea, and a bit of a radical socialist idea, that we will have to wait and see exactly what they're going to say, because I think a lot of what they are saying will actually be tempered back. I do think they will always want to try and tax the higher earners, the higher property owners as well. You can understand that from their perspective.
So we've discussed through a lot of the changes that have happened, that are on the horizon. Thought it'd be useful to run through a bit around what we're seeing people doing. As I mentioned, I think people are still active in the property market and still like property as an asset class. But I think a lot of people are perhaps changing their approach. We've mentioned international clients or those coming to the UK. As I say, traditionally we'd have put in place companies that they would have bought from for a variety of reasons. But now, given the changes, that's not the case anymore. We often look at direct ownership. Do you think that's had any sort of impact on the desirability of property for people coming to the UK?
No, not particularly. It's a nice idea. I mean, they are. all overseas buyers are used to their own regimes, their own way of purchasing property. So we find lots of different characters in the property market that bring their thoughts and everything over here. Some people understand it, some people don't understand it, but I think the more knowledge that they have is the better. And that's coming from solicitors and from tax advisors like yourself, Chris. And so even if they are sort of coming into the property market with both feet sort of forward, they normally take a step back quite quickly and reassess.
And I mentioned as well around the work that we've been doing on landlords and buy-to-let businesses in particular. Still a lot going on, particularly those where they've had high leverage in the past and it's been really a business for them. Some interesting things around incorporating those businesses, putting them into corporate structures where they already exist. That's been some interesting work, and I think clients are seeing the benefits of that going forward. As I say, buy-to-let market still seems very active. People are still seeing it as a way to invest for the longer term.
It's still very much there. I think it's been dulled a little bit recently, but like all these things, where it stops, it will start again. And people may club together to form these little companies. I've certainly heard of that. I haven't dealt with that, but that would be quite a tricky thing when they don't know each other. But maybe as a company, that's a better thing.
I think that's right. I think people want exposure to the property market, don't they? And it may be that they look for different ways to get that now. I think property funds, as you say, property clubs, I think would definitely be a route people would be keen to explore over the longer term.
Over the longer term, yes. I think property, everybody still loves property.
Yeah.
It's great. It keeps a roof over our heads. We see families grow. Young people sort of, when they're making it in the world, love to sort of go, well, I now own a flat. So it is very much in our Englishness, a Great Britishness. So properties will always sort of be quite a major part of any dinner party talk, any pub talk, anything like that. So it's very difficult to say that nothing is going to stop, like a buy-to-let or buying a trophy home. It doesn't matter. We've got Americans buying penthouses for £50 million and joining them together.
Yeah.
They're making a statement, and that is property. And I think throughout human existence, everybody's been having a go about property.
Yeah.
So it's in our blood.
Well, thank you, Will. Really interesting stuff. So I think the conclusion today is we've seen a raft of tax changes, both already in place over the past 6 years, but also those proposed, both in the short term, but also on the horizon. I think this means that it's very important that individuals do take advice in respect of any property transactions that they are undertaking. Will, any final comments?
Well, Chris, I think it's been excellent to talk it all through. There's some very fascinating bits to it. I think really any advice for any buyer or seller is to talk it through with the professionals, be that the professional estate agent like myself or the professional taxman as you are, Chris. And I think that when they have the knowledge, they can make their own minds up. But it's been really, really good to talk it all through, and it's been very, very fascinating. Thank you.
Oh no, thank you. So thank you, Will Tremlett from Sotheby's International Realty. Thank you all for listening as well. I've been Chris Springett, a tax partner here at Smith & Williamson. Our contact details are available as part of the podcast. Thank you again for listening to S&W The Pulse.
This S&W The Pulse podcast is of general nature and is not a substitute for professional advice. No responsibility can be accepted for the consequences of any action taken or refrained from as a result of what is said. The views expressed are not necessarily those of the presenter or of Smith & Williamson or any of its affiliates. No reproduction of this podcast may be made in whole or in part for professional or recreational purposes. No action should be taken based on this podcast, and we accept no liability if we change your views on any of the subjects mentioned.